Hey, it's Mark. Welcome back to the channel. In this video, I'm going to be talking about two of my favorite stocks, especially for 2024, and two that I made suggestions that you may want to look at pretty significantly at the beginning of the year. The two stocks are Tesla and Nvidia. I'm going to show you why one is absolutely crushing it right now and why the other one may be ready to absolutely crush it right now, so stay tuned. Let's start with stock, and you guys know if you watch my channel that Tesla is one of my favorite picks. I actually think in the next 5 years it's probably going to be the most valuable company in the world. I think it's like 6 companies under one umbrella, and they're all doing well. So just to briefly show you, most people think it's a car company, but I think that's like the smallest leg on the stool. I think it is a car company, but the car company allows it to do so many other things. I think number one, it's an AI company now. The cars are out there with cameras grabbing data, and that data is feeding into an AI, and it's allowing the cars to now drive by themselves. I think it's phenomenal. It's like the analogy is, 100 years ago when you got into an elevator to go to the top of a big building, there was somebody that would push the buttons and take you up. Well, now they don't have that person. I think cars are going to be like that too, and so does Elon Musk. So if you believe, like I do, that full self-driving and autopilot is the next big thing, it's an AI play. And Tesla's got more AI data than any other company in the world in any area. Now, you can say ChatGPT has a lot of data because it uses the whole internet, but AI actually in real life being used by Tesla, it's an amazing AI play. So that's the AI play. Then that AI play goes into robotaxi, where imagine Uber without a driver. That's all going to be fueled by AI. That's all fueled by their full self-driving. So they also are a battery storage technology. They make batteries, they put them in their car, but they also put batteries in your home. And they have solar panels that go in your home. But their battery technology is growing by like 100% a year. By the way, on their car, the Model Y is the best-selling car in the world, right? Now, here's the weird thing about this. I'm going to show you this chart. I'm putting it on a monthly, and I'm just going to say, you can look back over, right now it's about 231 bucks. And if you look back to this bar right here, you can see that in 2020, at the end of the year, it was worth this, roughly the same price that it is now. That was 4 years ago or 3.5 years ago. And it's still doing 4 times the amount of cars it's producing. It's a different company. I don't know what else to tell you. The last couple of things that are about it is a robotics company. So Elon Musk actually thinks the robotics will be the biggest leg of this stool of this company. He thinks that we're all going to want to have a $10,000 robot in our house. I don't know. I think I would. So a robot that might mow the lawn or do the laundry or cook the dinner, make the beds, vacuum the house. That sounds pretty appealing to me. I mean, people spend $600 on an iRobot little vacuum cleaner that goes around. So why wouldn't you spend on a robot though? All you got to do is train it to do all the things that you want in your house. Elon thinks that that's going to be a bigger thing. If you can lease that for $100 a month, I mean, that's a no-brainer, isn't it? Like, I think it is. I don't know. Anyway, so that's what Tesla's doing. Let's look at the chart on Tesla. This is over the last few days. Let me blow it up a little bit for you so that you can see. 5 days ago, the stock was around 200 bucks. Today, it just closed at $230. So it's up 15% just in 5 days. So it's actually quite amazing what's going on. And I think it's this full self-driving thing. They're planning a full self-drive mode launch in China and Europe. Imagine all of these cars out there that are now driving themselves. I think I heard the statistic, and I might botch this, but the accident rate on us driving our own cars for a regular car is 1 in about 174,000 miles, something like that. It might be 234,000, whatever. But for an automated vehicle in Tesla, for a Tesla, that's not regular other automated vehicles, nobody's in their game. It's 1 in 3.1 million miles for an accident. Like, that's a no-brainer for approval, right? Why wouldn't you approve that? It's 10 times better than human beings driving themselves, or actually 20 times better. So the numbers are crazy, and other companies can't catch up. They don't have the AI data. They don't have the hardware on their car. Now, I think Tesla's going to license it to them, and we'll start seeing other car companies licensing their technology and getting full self-driving. There's another revenue stream, insurance. it's going to go down. If you insure with Tesla, it's bound to go down if you have full self-driving in your car. I know for me, Geico says, hey, if you let us know, put this GPS thing on your car, and you have it on while you're driving around, we know how fast you're going, we'll give you a 10% discount. Imagine what that works like for Tesla. Okay, so back to the technical analysis. So we're looking at this stock actually in a break up. It's not a breakout yet. It's got to go up. It's got to fill this gap here from like 236 from a few weeks ago. And then it wants to go to this high over here of about 270. If it could get to 270, I think we're looking at 300 pretty easily. So I think the future right now, over the next couple of months, as we go into this 10/10 launch, this October 10th launch of Robotaxi and whatever they're going to be unveiling, there's some cool stuff that I'm starting to see. That's where the stock looks like it's got a runway to move. So I see this stock moving up to $300 before, the middle of October. That's where I see it. So you got to position yourself accordingly. This is a perfect stock to do the wheel strategy on, but I think in this case you start with covered calls, because in this case you'll be able to buy the stock, sell the calls against it, sell them a little bit ahead in this case because the market's still green. The stock is now green. So take a look at the stock real quick. You can see all of my indicators below here are green, right? You see all those greenies? That's like, we're lining up for that perfect pitch, and it's coming across the plate. Now look, I'm not Nostradamus. I don't know if stocks are going to go up or stocks going to go down. I just play the probabilities. The probabilities right now look like, with the Fed easing rates, with Tesla has gone through their growing pains over the last year for sure. I've sat through it for more than a year, actually more like 3 years, but just in the last year, the price of the stock has been really depressed. And it's because they have lowered expectations on how many cars they're going to sell. Their margins have been lowered. All that is changing. I think that's all behind them now. And so we're starting to see what's going on with the stock. Does it have a runway to run up another 70 points? It seems to me like it does. And if it does, you write covered calls. So here's the covered calls on it. And I'll talk about Nvidia in just a second. So here are the way the covered calls shake out. If you look at the covered calls for next week, today is the close of business. Let's take a quick look and see how this works. All right, so looking at the covered calls here, I would probably be looking at, if the stock is at 230 today, since it's green and since all of my indicators are green and since the market is green, I would probably be looking somewhere in here at the 235s or maybe even the 240s, right? Somewhere in here. Because if the stock is going to keep going up, you want to make a little bit of money on the way up. You just don't want to get put in a cash crunch. It's not like you're losing money if it goes over your strike. You want that. You just want to kind of guess it so that it's close to your strike price at expiration. So if you look at the do in the 235s, you would sell the 235s at 540 after buying the stock, or if you already own the stock, you could look at selling 235s for 540. And then you can look at the maximum covered call return. The computer calculates that for me. It's about 212% if you could do it over and over again, and if it goes, to its strike price, which I think it will. Of course, that's guessing. If you want to be a little bit more certain, you go to the 230s, which is where it is now. Like there's a 50% chance it goes over and a 50% chance it goes under if you're just looking plain old numbers. But this stock is actually trending. So to me, the probabilities are ahead of it. And it's trending on volume. So that is helping me say that I would go to the 235s. But what if you went to the 240s? You could look at the 240s out here and you can get 370 for those. You got 1,000 shares, you're picking up $3,700 a week on those. And you can eat on that, right? Maybe not with these inflationary things that we're fighting now. But that's a 277% return. Why do I talk about these percentage returns? Because they help me compare apples to apples, right? So I can look at an Nvidia covered call, I can look at a Tesla one, and I can say, you know what? Maybe at 277.93, I'm being a little too aggressive. Let me bring that back down because if I'm doing 211%, I'm doing really well. What if I just sold out the money and picked up 156? And you can see that calculation is a little higher than I normally shoot for, because I normally shoot for 1% to 2% a week and normally get it. Certainly get it on the juice. And you can see this implied volatility on these calls is 59. So it's jumping up, and that's what's giving us these great returns on it. Okay, so looking at Tesla, you can do this flywheel strategy, which is where you sell puts until you get the stock, then you sell calls until it's taken away, and then you go back and do the same thing over again. But in my opinion, because Tesla's kind of breaking out, kind of on a break up, let's call it, I would start with covered calls. Okay, let's look at Nvidia. So let's just take a quick look. This is the daily chart. Now this is a totally different feeling stock right now. Look at it. It's got a lot of red stuff going on. It's down over the last week or so because it had numbers, but they weren't what everybody expected, and maybe they said something that people didn't like, and maybe all these other sellers that have been making all this money are selling off, and maybe it's a later stage base and you shouldn't be buying a later stage base. All these reasons, but the bottom line is this stock is breaking down a little. Now, is it a strong breakdown or a weak one? Well, there's some good volume down here on some of these these down days. But at the end of the day, we did go down and test this $90 level, and we tested it on pretty good volume, but we rejected it. We came back up to this level. So this stock looks like the trend is still intact. Now, this might be an opportunity, and I like to have stocks that are breaking up like the Tesla that I just showed you, but this may be an opportunity for you to pick up some Nvidia cheap. Earnings are behind it, right? There's probably not going to be a lot of things that send it up except for the market. That's the wild card that's going on here, is the Fed is cutting rates. And if the Fed cuts rates and puts money into the system, basically allows cheaper money and more money to flow into the economy, that means people that don't have to pay for groceries, hopefully like you and me, that don't just live hand to mouth, that we have a little bit extra, we can put it into assets. What assets are we going to put them in? Well, I don't know. I put them into the #1 company in the world right now, and that's Nvidia, or Tesla, like I just mentioned, or Apple, or Google. But you're getting maybe a sale on Nvidia. I don't like to buy stocks on weakness, but I do like to buy stocks on sale. And so this is a stock that's going down right now, and it might stay here for a few more days or maybe even a couple of weeks. I don't know. I'm just trying to say, look, is there a bottom happening? Well, today it had some pretty decent action. So today was up a little bit, even though the candle's red. It was kind of up a little bit on lower volume. So it's trying to steady itself right here. Now, if we get a market that blows down, then this stock could see this moving average in play for sure, and maybe even go down to this $93 level. I don't know. But what I do know is that you can do the wheel strategy, what I call the flywheel strategy, on this stock. And that means you could sell puts. Now, if you sold puts, let's look at the put side over here. We go out a week, 8 days from now, and we say, all right, so we're going to sell puts on this. Let's go to about a 30 delta. That's the closest one right there, that 32. And so we would sell puts and pick up, if you have 1,000 shares of Nvidia, you'd pick up $1,850 for the week. Well, that's pretty good. You could do all right on that. And so the idea is that if you could sell those puts, that 103 price is under any of these lows that we've had here. That's about 104. Okay, so we've got a low sitting right there. Well, if we go underneath that low by doing the 103s, that's a pretty good chance that we don't get assigned. And that means we just keep the income. So we sell somebody the right to sell us the stock at 103. Well, I don't know about you, but I just said I wanted to buy it. So if I want to buy it, why wouldn't I want to buy it at 103? It's 107 today. I think 103 is a great place to buy it. And it's already been down there and tested that and has rejected it, and it's trying to get its footing here around the 107, 106 level. So you pick up $1,850 on that. Let's say that you don't want to wrap your head around the dark side, right? Selling puts is the dark side. It's still a bullish strategy, but if you want to own it, you might as well just go out and buy the stock of Nvidia. You could buy 1,000 shares of Nvidia, and you could turn around and you could sell the calls against it. Now, I wouldn't go too far out of the money on Nvidia like I'm doing on Tesla. Tesla is running up. I like stocks that are breaking up, right? It's not a breakout, but it's a break up. It looks like it has some momentum. I want that to move into my strike price. But I want to have more probability that I make this money. So what I'm going to do is the stock closed at 107.21, and the options at the 107, they're slightly in the money, are about $3.75. So what I'm going to do is I'm going to buy the stock at, 107.21 or whatever, somewhere around here, and I'm going to sell those 107s at the money. I'm going to pick up 375. That's like 3.5% for the week. Okay? And you can see that turns into 182% for the year. So you buy the stock, you sell the calls against it. Now, here's what could happen with Nvidia. And this is why the game is so interesting, right? This is why this is so much fun. Is that if it goes to 110, not that you lose money, you still make your 375, but you're going to have to cough up a little bit of money to buy that back as it goes higher than your strike price. You're making the maximum amount on your trade. This is what a lot of people don't get. They think, oh my God, I'm losing money because it's going over my strike price. You're not losing money. Your base position has gone up. Like if it goes to 110, the base position that you bought at 107.21 is now 110. That's moved up. But your position has also moved against you by the same amount that the stock has moved up. What have you kept? You've kept the juice, this 375, right? So you'll have to spend $3 out of your pocket, but that $3 comes from the increase in the base of the stock. Now, if it goes up and back down and up and back down, that's something I call the whipsaw. And if you get a whipsaw, well, that could eat up your account. But the idea is that we're not going to get a whipsaw. We're trying to find stocks that are moving higher, right? And so we're trying to sell calls against them at the right spot. Now, I like in-the-money calls. Everybody knows me as the in-the-money call guy because why? Well, let's say we sold the 104s and we said, well, that gives you $5.50 of cushion, right? Which means this stock at 107 could go down $5.50 and we still haven't lost any money. We're picking up $5.50 a cushion and we're picking up $3.07 of juice versus the one that's at the money, we're picking $3.80 of juice. If you want to be really conservative, you do these 104s, you pick up $5.50, $3.09 of it is juice to give you all the way down to 102 before you start to lose money. So it depends on how strategic, conservative, aggressive, however you want to do this. That's why options are so cool. And so I don't know. I think Nvidia is a buy here. So I'm not going to go so deep in the money on this. If you're new, there's nothing wrong with going deeper in the money. But if you're, I think at the money on this one is probably your best bet. That $167, 67% return is what I'd be looking at. So I would use the wheel strategy on both of these stocks. I think both of these stocks are headed higher over the long term. We're not doing this to day trade. We're not doing this even for the week. The reason I show you the max covered call return right here on the chart is because I want you to think longer term. And so, I think Nvidia is going to be a $2,000 stock in a couple of years. And right now you're going to look at me and go, oh, that Mark Yeage's crazy. Yeah, I'm a little crazy. I'm also a little bit ahead of my time usually on some of these things. So you should at least listen and maybe start doing some research around what I'm talking about, because I've done a ton of research on Tesla. And like I told you, there's like a bunch of companies under one symbol. I've never seen a stock like this except maybe Apple. Apple has phones and, AirPods and, earphones and subscriptions and music and TVs. And, that's a multi-tiered or multi-revenue fingered company. The same thing with Tesla. Nvidia does AI chips, right? Chipotle sells burritos, but Tesla's got a bunch of stuff under that umbrella. Like, I don't see why it's so cheap, but it is. And so maybe we'll look back and say, well, now we see why it's cheap. Or maybe we'll look back and go, oh my God, I wish I had loaded up on that stock when I had the chance at $230. Anyway, thank you for listening. If you want to watch this next video, this will tell you how to do covered calls if you don't know how to do covered calls. And as always, I'd love for you to subscribe. And my goal is to teach people how to invest. That's my goal. Because if you can do it this way, think about it. If you can make 1 to 2% a week, what's that in a year? 50 weeks in a year, let's say. That's 50 to 100% a year. Now, you're not going to always make that, but you're always going to make the juice. And if the stock stays the same or goes higher, you're going to keep collecting that juice. So you've got to have a long-term perspective. If you bought Nvidia and just sat here and it didn't do anything, like I showed you Tesla didn't do anything for almost 4 years, it's gone up and down. If you didn't sell calls against it, you'd be about even. But if you were making 1 to 2% a week for the last 4 years, yes, it has come down, so you have the stock decay a bit to deal with, but you would have been at least making some income. That's what covered calls and selling puts can do for you. It brings in money from an outside source, the buyer of the calls or the buyers of the puts. Those people are putting money into your account. All you have to do is give up a little bit of the upside when the stock does move up. And if you can kind of figure out where the right spot on the chart is to do that, that's where the sweet spot is. So anyway, subscribe, like the channel, subscribe to my newsletter if you want. There's a link below. But I'll see you on the next video. Thanks for being with me. Take care.